hone in for a second because I'm not sure we've been talking enough about it, but that funding stress we've seen in SOFR, I know there was data that was put out on Monday showing just a huge drop in that secured overnight financing rate on Halloween from the day before. Should we be paying closer attention to that and what that's meant in terms of the liquidity picture across asset classes?
Well, people definitely pay attention, Morgan, because one, as you know, that can often be an early sign of stress, but it also takes place when there's window dressing. So and banks are doing window dressing at the end of month. So I am kind of watching it, but I think those funding stresses have eased. And of course, it hasn't spilled over and reflected in what should be building stress in either credit markets or in bank equities. And so I would just say that it's an anomaly and it may be due to the shutdown. But yeah, it's worth watching.
The fact that we have had this deleveraging event, if you will, in Bitcoin, I mean, what do you watch to know that that's washed out? And I guess perhaps just as importantly, has this been playing out the way it has previously in the market?
Yeah, in some ways. I mean, I think we have to go back to two different episodes. 2022 when FTX collapsed, and then in 2020 when we had the COVID shock. And in both cases, those were really widespread deleveraging events in crypto, because as you know, in crypto, there is typically a lot of leverage. The October 10th deleveraging was the biggest in history. And that means there are still ripple effects being felt even 2 weeks later. There has been a DeFi protocol streamer that actually reported a pretty sizable loss, and that created further ripple effects. And that's what happened yesterday, along with this thing called the balancer hack. So I'd say it's probably still a couple more weeks. The good news is there aren't a lot of bodies floating to the surface, so it doesn't feel systematic, but it's going to take some time for confidence to come back. And I think that's why crypto took it so hard in the last couple of weeks.
Because we did have a bit of a bounce back here in Bitcoin and really across the crypto landscape today. But yesterday, as Katie Stockton over at Fairlead pointed out, Bitcoin broke below its 200-day moving average. I know she's watching some technicals there pretty closely. How about you?
Yeah, I mean, I think it makes sense to watch the technicals for Bitcoin. As you know, Bitcoin is very sensitive to market liquidity and also perceptions about risk appetite and risk premia. And, over the past couple of weeks, I think there have been headwinds building, right? From the government shutdown to a hawkish Fed cut that was done last month and uncertainty about December. And as you know, with the shutdown, Treasury liquidity, the Treasury general account's actually been building cash. So I think all of these created a cascade of problems that put pressure on crypto. But hopefully, as you know, headwinds become tailwinds when you can resolve these things.
The read through to stocks, specifically the QQQ or the Nasdaq 100, we know there's always been this very strong, or in more recent years, a strong correlation between the two.
Yeah, and the linkages are growing because, as you know, like market makers actually trade both products. And I think in general, people get nervous because part of it is stocks have been up 6 months in a row. And we have to keep in mind that in October, we had the wobble in the first half before markets found their footing. I wouldn't be surprised if people are just pausing here and saying, look, we still have the shutdown. We've had 6 months in a row, stocks are up, markets are overbought, and they get a little nervous. But let's say that just means a wobble in the first half of November. Since 1928, 100 years of data, when markets have been up 6 months in a row, 5 or 6 times you build on those gains with an average gain of 3%. And in 1936, the market was flat. 1942. So in other words, you either have a flat November or actually strong. It's actually a good sign we've been up for 6 months in a row.
And all the focus there's been on stretched valuations, particularly tied to the AI trade. Do you anticipate here then into the final weeks of the year that we're going to actually start to see this broaden out a bit?
Yeah, it makes sense. I think, we are doing more Zooms with institutional investors where they're talking about not 2026. So they're trying to position. And I mean, part of me would say, I think the Mag 7 and the AI stocks are still reasonably valued because they're growing at more than double-digit growth rates. And even NVIDIA, the biggest name and most important stocks, only at 29 times forward earnings. So they're not demanding. But there are plenty of stocks that have underperformed for 3 years, where they're underperformance is so severe, you haven't seen it in 50 years. And so I think there is going to be some folks looking to buy mean reverting ideas, but I'd still say I like the AI. I think there's a lot of visibility, and I think companies are starting to see payoffs, so it still makes sense to stick with it. People have been looking at AI through the lens of AI is something taking place that's, being built around a handful of companies, and we've seen the visibility of the capex, more than several $1 trillion over the next 5 years for hyperscalers, for LLMs, and then of course the commensurate security protocols being built. But I think what's becoming evident for those who are studying AI is that in this agentic world, that means that a lot of the AI agents and software actually work on what I'd call intercompany basis, or I guess we'd call it internet. And that means it's going to be important to verify transactions and to really create security around this, especially as we think about robots out there and other things ingesting information. It's going to be a vastly more complicated world where instructions need to be verified, right? I mean, if we have autonomous agents driving cars, conducting transactions, even running our everyday lives, whether it's as a consumer, that means setting up travel, verifying bank transactions, for enterprises, it's numerous enterprise transactions. We're going to need to be sure that these are verified and have the finality that we do today with payment systems. And so the natural place where this is going to take place in our view, especially given the idea of using tokens to send instructions, is on a blockchain. And that's where I think virtuals is going to play an important role. This is one of many companies, but this is a company that has many merits and unique architecture. And I think that's what Thomas's report really makes evident. If you haven't seen it, it's really comprehensive and pretty well laid out. And so I think it's an important it's an important time, because this is 2026 is the time that investors and companies and enterprises are going to start to think about the importance of verified proof of provenance of an instruction. And so that's where I think a lot of this work is going to really start to become central. Crypto and equities historically moved in sync. So in periods when equities are doing well, crypto does well. The linkage, of course, is both monetary liquidity, risk appetite, and of course, leverage. So when stocks are going up, investors have confidence, and especially if the Fed is being dovish, and therefore people buy crypto. But this kind of diverged after October 10th, which is a couple of weeks ago, because there was a massive